we find ourselves in a situation where we have a war in Europe. The inflationary impact of this as a result of what is going on with Russia is absolutely enormous. You have a Fed that is stepping on the brake very aggressively. Does all of that come together basically to signal a recession? Is that the way that you're now thinking about the world?
So I think 12 months ago, we talked about the markets being hooked on stimulus and liquidity. And I think this year could be the year that we start to see what cold turkey really looks like in an atmosphere of heightened valuation uncertainty. And so if we start with credit, I think there's a few things that people are not talking enough about. I think the first one is that the cost of borrowing is not going to be free anymore. The hurdle rates are not going to be ultra low anymore. And what that means is buying a basket of credit, diversified, and adding leverage on top to get to where you'd like to be in terms of return. Yep. I'm not sure that's going to cut it this year, Guy. And so I think that when you have an equity valuation cushion ahead of you in debt, which is less stable because of possibly a recession or at least a slowdown with these rate hikes and central bank printing less money or reducing their balance sheets, you probably want to be higher up the capital structure in senior secured than chasing the yield that's at the bottom. And the other reason I say that is if you look at all of the high yield debt that was issued in the pandemic in the 5% coupon zip code, that's starting to look like it would need some kind of repricing or readjustment when rates are heading steadily, north of 3%.
Sachin,
and so I think there's not enough to talk about this right now.
What about the fact that borrowing costs going up could put many investors in a squeeze here who are relying on leverage to engage in these markets? Do you see, when you look around yourself, at your rivals, at your peers, that there's a lot of pain out there?
I do. I'm not sure it's going to be today, but I think we're creeping into it. And that's why I said I'd rather be looking senior secured than looking junior at the moment. And it's also why we see something of a bit of a pivot. So when you have public markets, which are in the state they're in right now, and what we're anticipating to happen, we're probably pivoting a bit to private markets and taking that illiquidity return premium because we can take advantage of some things you're talking about, whether it's secondary stakes, whether it's private credit, where asset managers are bypassing Wall Street entirely, or whether it's other sectors that hopefully are less correlated to the macroeconomy, like like insurance, or infrastructure and real estate.
Well, you were talking, this is Kriti in New York, by the way, you were talking about simply the risks that are coming to the economy. Let's talk about, instead of the liquidity of the markets, the liquidity of the consumer and of really corporate America here. There is still a lot of money flowing around simply from the excessive amounts, record amounts, I should say, of fundraising that happened in 2020 and arguably 2021 as well, not to mention that government stimulus. How does that factor in terms of really preparing, I guess, the end consumer and a lot of these corporations for perhaps demand destruction, perhaps those commodity shocks?
So I think it's a little bit early to tell because it depends on the pace of the developments we talked about, whether you're talking about rate hikes or you're talking about slowing down the economy. But I think as far as investing is concerned and our pivot, let's say, to private markets, I think you'll see a real flight to the first tier because it'll be quite apparent within a few quarters of mark-to-market valuations which investment firms have been able to navigate that environment in private markets as things have just become, a lot less easy than let's say, in the last few years through the pandemic. It was a very profitable period through the pandemic for a lot of these firms, and I think we'll see much more differentiation in the near term. And if you look at, for example, Kriti, what's going to happen with the repricing of buyout debt and some of the other securities we've talked about, they're going to be repricing into a much less benign financial environment.
Sachin,
and so
I want to talk about repricing, and I want to talk about private assets in the vein of Roman Abramovich over here, because you have a lot of peers, a lot of the folks that are involved here when it comes to the Chelsea Football Club and buying the asset from Abramovich, whose assets are frozen. Can you talk to me about the difficulties here in an asset sale like this and the dilemmas that are arising for the folks looking to buy assets here from billionaires who are Russian?
So, look, I think there'll have to be transparency when the sale clears. I mean, I'm not sure whether you're going to get a full sources and uses page to figure out exactly where the money's coming from and exactly where it's going, but you're probably not that far off because everyone's going to want to know exactly where the proceeds are going. But I think a lot of that has been addressed by what's been announced already, that I understand at least the proceeds will be going to victims. What's interesting here is that you have, the forced sale of a first-class asset, an operating asset, that employs a lot of people and represents, one of the important cultural icons of the sports industry in the UK. And there's no surprise, I think, that you have investors who would have a financial background looking at this asset, precisely, Sonali, because it's complex. You have the real estate, which is a complex set of parcels. The pitch is owned by one entity. You have properties around the stadium that will need to be unlocked in order to develop the stadium. So
Yep.
I think, in terms of looking at where to put money to work in a sort of complex geopolitical environment, I think there's no surprise that you're going to have people with a financial background looking at that asset.